What if I told you that silver, the metal trading at $77 per ounce today, could either surge past $100 again or crash below $60 in the coming months? And that the decisive break is already being set up right now, while most investors remain completely blind to it. Welcome to the silver equilibrium trap of 2026. Shh. Let's start with the insane ride we've just witnessed. Silver absolutely exploded in 2025, delivering a jaw-dropping 147% return, its strongest performance since 1979. If you invested $10,000 in silver at the start of 2025, you'd be sitting on nearly $25,000 today. But here's where it gets wild. In January 2026, silver went parabolic, breaching the psychologically crucial $100 barrier for the first time in history and hitting an all-time record of $121.60 on January 29th. The gold-to-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, collapsed below 50 for the first time since 2012. Then came the crash. Within weeks, silver plunged more than 35%, dropping from $121.21 to around $77. That's not a correction, that's a financial earthquake. And yet, despite this violent volatility, JP Morgan still forecasts silver averaging $81 per ounce for 2026, with some analysts predicting it could trade above $100 later this year. So, what's really happening here? Why is silver acting like a financial roller coaster on steroids? Shh. Here's the fundamental reality most people miss. Silver has been in a structural supply deficit for 6 consecutive years, from 2021 through 2026. According to the Silver Institute, demand has exceeded supply by 50 to 250 million ounces annually. That's like a 60,000 to 300,000 ton shortage in a market where total mine production is only around 850 million ounces per year. Think about that. For 6 years straight, we've been consuming more silver than we're producing. The 2026 deficit is expected to reach 67 million ounces, even as total supply climbs to a decade high of 1.05 billion ounces. But here's the catch. Silver has massive above-ground stockpiles that have been buffering this deficit. For years, the market has been drawing down these inventories. But in late 2025, something extraordinary happened. Fears of potential Donald Trump administration tariffs under Section 232 investigations caused enormous amounts of physical silver to be moved from London, the world's physical silver hub, to New York City's COMEX futures exchange as a hedge against import duties. This movement drained London's physical market dry, creating extreme illiquidity. When you combine years of structural deficits with suddenly vanishing physical metal, you get explosive price action. That's what ignited silver's rocket ship to $121. Now let's talk about what makes silver unique and dangerous. Unlike gold, which is primarily bought for jewelry and investment, about 60% of silver demand comes from industrial applications. Silver is one of the world's best conductors of electricity, making it essential for electronics, electric vehicles, AI data centers, and especially solar panels. Solar demand alone has grown from 80 million ounces in 2016 to over 200 million ounces today, a major driver of the supply deficit. But here's the equilibrium trap. High silver prices are now threatening to destroy the very demand that drove them up. Historically, silver represented just 1.5% of a solar panel's cost. Today, with silver above $75 an ounce, that figure has exploded to over 30%. That's not sustainable. Major Chinese solar manufacturers are already announcing plans to thrift silver usage and substitute with copper or develop entirely silverless panels. JP Morgan warns that this substitution trend could severely restrict future silver demand growth. The Silver Institute forecasts that industrial silver fabrication will decline by 2% in 2026 to a 4-year low of 650 million ounces, driven primarily by the solar sector pulling back. This is the trap. Silver prices rose because of tight supply and strong industrial demand. Entirely silverless panels. JP Morgan warns that this substitution trend could severely restrict future silver demand growth. The Silver Institute forecasts that industrial silver fabrication will decline by 2% in 2026 to a 4-year low of 650 million ounces, driven primarily by the solar sector pulling back. This is the trap. Silver prices rose because of tight supply and strong industrial demand. But those high prices are now accelerating substitution, which could collapse future demand and undermine the very thesis that drove prices higher. While industrial demand weakens, investment demand is going wild. Physical investment is forecast to surge 20% in 2026 to 227 million ounces, a three-year high. Western investors are piling back in after 3 years of decline, and Indian and Chinese retail buyers drove much of January's parabolic move. But here's what has J.P. Morgan's analysts concerned. In early January, silver prices kept climbing even as global ETF holdings were falling. That's a major red flag. It means the rally was being driven by speculative retail frenzy, not institutional conviction. When Kevin Warsh was nominated as the new Federal Reserve Chair, the catalyst triggered a market-wide precious metals sell-off. But silver's 10-15% drops on days when gold fell just 1-2% revealed how overextended and frothy the market had become. Gregory Shearer, head of precious metals research at J.P. Morgan, is explicit. We're much more apprehensive on silver. We don't necessarily trust that you would potentially shake in the full amount of froth out of this price. Translation: more downside is possible before silver finds its footing. The gold to silver ratio tells the story. In November 2025, it was 80,001. At silver's peak, it fell below 50,001. Today, even after the crash, it's only back to 65,001, suggesting silver is still relatively expensive compared to gold. So here's the equilibrium trap. Silver is caught between bullish structural forces and bearish cyclical threats. Nupple case: 6 years of structural deficits with tight physical supply, above-ground stockpiles being drawn downtown. Being down crescent minor. A bunt crappennies near $5,000 supporting silver metal relationship. Potential government stockpiling of critical minerals. AI, EVs, and data centers driving new industrial applications. The bear case: a colorate solar rating solar to string. If Donald Trump implements Section 232 tariffs on silver imports after the current 180-day negotiation period, you'd see another scramble for metal and physical tightness bullish. If the Fed turns aggressively hawkish, or if solar substitution accelerates faster than expected bearish. J.P. Morgan expects silver to end 2026 around $85 per ounce, but admits they're cautious about re-engaging until more speculative froth is cleared out. Other analysts like Alan Hebert from Gold Silver believe silver could trade above $100 as supply deficits deepen. The truth? We're at an inflection point. Silver could break 30% higher past $100 if investment demand holds and physical tightness returns. Or it could break 30% lower toward $55 if substitution accelerates and the speculative bubble fully deflates. The equilibrium trap is real. Silver's fundamentals are simultaneously the strongest and most fragile they've been in decades. The break is coming, but which direction it goes depends on forces colliding right now beneath the surface that most investors don't see.